Good evening, everyone, and welcome to tonight's webinar. My name's Michael. You'll see my image in a moment. Tonight we're presenting a webinar on the foundations of property investment. Thanks for joining us. This is the webinar format tonight, which means that all of the people who have attended will be on mute. We won't be taking questions during the webinar, but via your voice, but we encourage you to type the questions, any questions that you might have, into the GoToWebinar tab on the side of your screen. Once we do that, we'll get back to you with answers to your questions after the webinar has finished. Again, thanks for joining us. So tonight, we're in for a bit of a treat. We've got three experienced property investors talking to the group, and we're going to cover a range of topics that are broadly covered under the heading of foundations of property investment. So as you can see, I'm now a branch manager in South Australia, and my wife and I are property investors. Roger's going to talk as well. Roger's based in Victoria. He is a experienced property investor as well. Joe Linko is in New South Wales. He's a licensed mortgage broker and a property investor. We have a couple of hundred people registered tonight, which is pretty exciting. So hopefully we provide the information to all of you that suits what you're looking for. If you're new to the Property Club, we thank you for having the bravery to join us for the first time tonight. Someone will contact you after the webinar and see if you have any further questions and explain how we can help you further. So I'm just going to give a brief disclaimer. So tonight we're going to talk about investing in property. We think that property represents a fantastic investment for the majority of people. We are not licensed financial planners, and apart from Joe, we're not licensed brokers. And so tonight we encourage you to take the information and then go and check that with your professionals that you prefer to use, accountants, solicitors, or financial planners. So tonight we're going to cover a range of things, as you can see. First of all, we're going to cover why invest in property. We're going to cover strategies to build a property portfolio. We're going to look at the property portfolio, the performance of property over time. We're going to look at different property types, locations, and the importance of diversification. And then we're going to learn about property finance. So if you haven't heard about Property Club before, we'll go into tonight and explain a bit more about the club. But we are a national club of property investors, a broad network. We have what are called property mentors in our club, who are not salespeople. They are experienced property investors that help new people either to start their property investment journey or to extend it. Across the country, we have approximately 80,000 members, and so we have some fantastic bargaining power with a range of services that we can obtain. You'll see that later on. The club has been around in Australia for 26 years, and in that time, Property Club members have purchased something like 20,000 investment properties. There's no other organisation in Australia that has a record like that. We're realistic. We know that across the country, the property industry doesn't always have a great rep. In fact, we're one of the least trusted professions in Australia. It's an industry that's full of promises and sales tactics disguised as education. And every man and his dog, if you Google property investment, is offering you financial freedom. It's very difficult to understand what's actually going on and what's real. So the promise we make to you from the very start tonight is that you will not get sales tactics from us. You will not get hard sell from us. No one should invest in property at any point in time until they completely understand what is going on and can explain it back to anyone, including the property mentor. 98% of the property mentors that are in the Property Club who help other people derive the majority of their family income from outside employment or businesses. So that means that they're not trying to get you to buy a property so that they can put meal on the table for their family. There's a no BS promise from us. We'll give you the pros and the cons and give you the space to make your decision. And the other thing we commit to is that we won't ghost you. What does that mean? Ghosting is when you enter a property transaction and by the time you've entered the transaction, the person that's helped you get there has run a mile. They're not there to support you. They're not there to answer your questions. They're not there to guide you. That is exactly what we do not stand for. We are an organisation that commits to providing ongoing support to our members for life. You will have our personal numbers and you will have our personal email addresses. We're here to support you. All right, so let's start talking about property investment. How can property help you in retirement? Well, you can see the current age pension numbers here, and some of these are a bit scary. So we see that for the average couple, something around 35,000 is the annual income that a couple is going to earn if they're on the pension. I've had a look into the details of what that actually means and what is estimated that they can afford, and it's not great. I don't think, I'd like to think that everyone on this webinar tonight is on here because they can see something better for themselves in the future than relying on the pension. But there's a bit of a reality check for some people here. So the average superannuation payouts now aren't as big as perhaps what some people think. So the average payout for a male is less than 300,000, and for a female is under 150,000. I think most people wouldn't realise that that's the case. And I should have said both the previous slide and this slide, these are not our figures. These are figures that are produced by ASFA, who produce a lot of superannuation related figures for Australians. Now, the screen just decided to freeze for a moment there. So what we've done is had a look at a comfortable retirement and in particular, what that means and how much it costs to live comfortably in retirement. So you'll see there that the grand total is around $60,000 a year to live comfortably in retirement. Now, when you drop down a level and look into the detail of what that means that that's based on the assumption that you can afford to run your air conditioner and heater. That means that you will be able to undertake some domestic and occasional overseas travel. It means that you will own a reasonable car, not a late model car, a reasonable car, and that you will be able to afford to take part of a range of regular leisure activities. Now, the people that I speak to certainly aspire to have a retirement that has a lot more elements to it than that, and as such will require a greater level of income. If you're retiring at 65 and you're going to live to 82 and you're deriving $60,000 per year, you can see that you'll need just over $1 million at the time you retire. Retiring at 60 and living to 82, you're going to need 1.3 million. So the question that I have for you is, how are you going on the track to achieve this? Are you well on the way? Are you puzzled? Are you worried? And for those who are well on the way, what are the extra things you could do to enhance your lifestyle in retirement? So at this point, I'm just going to pause and I'm going to hand over to Roger Galway, and Roger's going to talk further about the Property Club's game plan and how it might apply to you. Thanks, Roger.
Okay, thanks, Michael, and welcome everyone. And we've got a huge number of members attending, so thank you for taking this time to listen to what we have to present. Well, one of the things which we look at doing, and as you know, we talk to people about property and why we consider ourselves investing in property. Well, why do we use property? What's the reason for property? And I'm going to go through a couple of things on why property. Next, Mike, thanks.
Please just keep talking. I'm having some problems projecting the slides.
Okay, so what I'm going to touch base on why what is the reason for property and what is why we tell people to invest in property. A couple of main things is very high leverage which is available. Okay, we know that property in Australia here has had long-term capital growth, and if you look at it, and we've got some slides later on to show you how over a period of time there is long-term capital growth. It is not a quick get rich quick scheme. We talk about why it is minimal or no cash needed, and Joe will cover that a little bit on how to use your equity and how to use your money or deposits to come into that. So there's a various raft of options for you as a new investor. We also, one thing with property, you get rental income, very strong rental income which you're able to get for your properties. Okay, then the other thing is, which is an important part of investing, is your tax, the tax savings which you can get. That's another important part, another factor in your investment journey. And then the risk is very low. So we talk about why is the risk low? Because the banks are willing to lend you 80-90% of the value of the property. Right. Okay. So the other thing we spoke about taxes. Now, are you aware that generally when you work on a 5-day week, Mondays and Tuesdays wages generally go to the taxman? Now, how do you say that? Because most of us are paying between 20 to 30%, or even sometimes more, on or we pay tax. So what are we doing? So we are working for the ATO. Yes, we are doing it, and nothing. Don't get me wrong. I'm not saying to shirk your responsibility of paying tax, but what we show you is how to use that red portion to fund your investments. So let's have a look at how that can happen. Right. One of the best things about property is your leveraging. So let's take, for example, so we take 2 cycles of 30 years. So 15 years, 1 cycle, and a 30-year cycle. So let's say you start off with $45,000. With $45,000, if you put it into a savings in your bank account, you save your money. The bank will give you interest, which is not much nowadays, but say that 45,000 will remain pretty much 45,000. It doesn't go very far. It may go up a little bit, but with inflation, you're pretty much knocked out. Right? Say you take that same 45,000 and buy a car or a boat. You can get a decent new car for 45,000. Well, in year 15, it'll be worth 15,000 if you're lucky. In 30 years, generally, we are saying it's worth 5,000, but generally you have to call someone to come and pick it up from your driveway. But let's say for this example, it is worth $5,000. Now, you have your super. You take your super, you put 45,000 in your super. In 15 years, it'll double. It's done well. You'll get $90,000. And in another 15 years, that 90,000 will become 180,000. Pretty good if you look at it. Now, let's say you take that same 45,000 and you go to the bank and you borrow money from the bank. So you go to the bank and you say, you go to the bank, or you go to a broker like Joe, who's a very good broker. And what he will do is he will get you a loan for 405,000, and you can buy a property worth 450,000. Right? So you've put 45,000, you've put 10%, and the balance 90% you're borrowing. Now, I'm not going to go through the costs and all that. Now, you can use it from cash or available equity or from different options, as I said. Now, let's say in 15 years, that property doubles. So what happens? It becomes 900,000. Now, the property's value is 900,000, but your loan remains the same at 405,000. Right? And I'm not going to go into interest only and principal interest. Let's say your loan remains at 405,000. The balance of that is 495,000, which is your money. It's not the bank's money. All the bank is interested in the 405,000. The balance is your equity, which is called equity. The difference between the loan and the value and the loan is your equity. So that's 495,000. So that's pretty exciting. But it gets really more exciting when you look at the next cycle. So if in 30 years' time, the value of your property goes to 1.8 million. So it's doubled from 900 to 1.8 million. Your loan is 405,000. Okay, that remains the same. That hasn't changed. And how much you're left with? You're left with 1.395 million. That is a huge number, and that is your money. So you think about that. Your $45,000, which you started off in year 1, you have increase that to 1.395 million in 30 years. Thank you very much. I'll have 5 of those. Okay, so that's why the leverage of property is great. Okay, now what I'm going to talk about here is just the change in dwelling values over a period of time. And you look at it over the last 12 months, what has happened is, and this index is from CoreLogic, you look at it, the national average has changed over this period of time. And where it has changed the most is in the total return in Sydney and Melbourne. Okay, if you look at those numbers, you got 78.8% return and Melbourne has 16%. So yes, the growth is there over a period of time. So if you take your monthly growth, there's small changes here and there, but over a period of the annual growth and the total return, Sydney and Melbourne and Brisbane are the three main top cities, and that's why we focus very much on the city areas. Okay, right. Right. The next thing I want to talk about is the time in the market. And this is very important from a point of view of long term. See, as we said, property is a long term proposition. And when we talk about it, generally, when you look at houses, if you buy a property and generally the length of time if you hold it for less than a year, generally 47% will make a loss. Okay? Or generally you lose. Now, what we are saying is if you look at the other end of the scale, if you hold property for over 15 years or more, 95% of people, okay, will make a profit of over around 100% profit. That's over 15 years or more. Now we're not saying every single property, but generally property over a 15-year period or more will make good money for you. And that's why we talk about holding property in the long term and the time in the market. It's not when you buy, it's how long you stay in the market for. And that's why we encourage all our members to buy and hold property for a long term. Okay, talking about property trends, as I said before, for the last 30 years, if you look at the scale, we started off in the 1980s and all that. We've had so many different changes. Okay, we've had negative gearing disappeared. We had the recession. We had interest rates at 17%. I wonder how many people remember that. We had higher unemployment. We had the Gulf Wars. We had GST introduced. September 11 happened, and then we had so many different things. We had the stock market crash, and now with the COVID-19, I'm sure there will be a small adjustment in the price. But if you look at it, generally properties have grown in value over a period of time. Yes, there's different levels and there's different trajectories, but at the end of the day, property prices over a period of time will grow in value. Okay, this is another important thing which we want to touch base today about is the property clock. And when you look at it, this is from Heron Todd White, which is which is one of our biggest valuers, and they do analysis for properties nationally. And when you look at it, they're all predicting that where Sydney, Melbourne, and Brisbane are, they're at the start of recovery, and Adelaide is not far away from starting that recovery trend. So that's what we want to go. This is where you want to buy, and you'll hear this saying about buying at 7 o'clock, because that's when the best part to buy your properties and then you start recovering, and that's where you want to be. So you don't want to buy at the peak of the market at 12 o'clock. You want to be buying at 7 o'clock. So this is a good time to look at Melbourne, Sydney, or Brisbane or Adelaide. So what's your game plan? And now we're going to get Michael to continue and talk about the game plan.
Thanks, Roger. So essentially, you can see some key principles written in blue on the screen. One says use other people's money. We don't necessarily mean your neighbour or your brother or your sister. We mean using money that's provided by lending institutions like banks. And we encourage you to do that. So I encourage you to use the smallest amount of equity or cash or savings that you've got to contribute towards the purchase of property. And you use that to fund the deposit on the property and the government and closing costs associated with it. The rest of the money you borrow that from a lending institution, and Joe will talk about that in a few minutes about what that looks like. So when you do that, you can actually replicate that because you don't need a lot of money for each property you purchase. You just need to make sure that the bank's comfortable lending you with money. So the strategy that I use and that Roger uses and that Joe uses is one that's based on contributing a small amount of cash or equity to purchase a property, but having the bank or the lender finance the significant majority of the purchase. That's in a nutshell.
Thing which you add over there also, Michael, one thing which you add over there, Michael, is the fact is that we duplicate that and triplicate it, and you use the same process over and over again to build a portfolio of properties.
Absolutely, and this is why you do it, because what we've just seen is that property markets perform at different times and at different rates. So we talk to property club members and potential investors, and we talk to them about the opportunities that exist in markets all around the country. Now, very commonly, so I'm in Adelaide, very commonly I might deal with someone in Adelaide who says, I want to purchase another property in Adelaide, I've got my home here, and we'll say, well, that's up to you. Have you weighed up what the potential growth rates are or the potential rental return is in other markets? And if people decide ultimately that they still want to purchase in Adelaide, for example, then we help them with that. But sometimes when they see the numbers that relate to other markets, and I'm going to use Sydney and Melbourne just as an example, they might decide that that represents a better use of their money. But it's also good to have a much wider diversification of your property holdings in as many places as you possibly can. So now what I'm going to do is talk to you a little bit about Property Club, because for those people on the line who don't know anything about us, this next 5 minutes will be really quite important. We told you a little bit at the start, and we're going to keep going. So I'm not going to read everything on this slide, and I'm not expecting you to have read everything. But there's a couple of things that I just want to point out that I think are really important. First of all, every person who joins the Property Club is allocated their own property mentor. That property mentor is someone who is an experienced property investor, and their role is to guide, help, and support you on your property investment journey. There's a range of other things on this slide that are important, and we're going to go through a few of them in a bit more detail. But the role of the property mentor is so important, and it is so unique to what the Property Club offers compared to any of its competition. So our property mentors provide a personalised service. So what does that mean? Well, we've trademarked a term called REAL to describe the education that we provide. So it's an acronym, and it means that the education and support that we provide is relevant to you. Every person that I've dealt with, and I'm sure Roger and Joe would feel the same way, is at a different level of understanding about property investment. So someone who's a sophisticated property investor who joins our club and already owns, say, 6 investment properties, we're not going to talk to them at the same basic level that we would if someone joined brand new. So we're going to tailor the messaging, the education that we give that member based on their current level of knowledge and understanding. We encourage questions and analysis. Property Club members will always have the opportunity to ask as many questions on a range of topics to do with their properties as they possibly can. The only silly question is the one that's not asked. And we provide and we support our members to do a wide range of analysis on any property that they're looking at. We advocate knowledge sharing. This is quite unique in terms of the services that we provide, because we run social functions at other times of the year when we can meet face to face. We provide social functions and opportunities for Property Club members to mix and mingle and share war stories and share great stories. And a lot of other competitors to the Property Club don't offer that service. They try to keep their previous purchases away from their new purchases because they're worried that they're going to tarnish the view of their incoming purchases. But what we say is, no, let's put it all on the table. Let's cut the BS and let's be open about property investment. It's a journey, and it doesn't always go that way. But it doesn't always go perfectly. But as you can see, the results are well worth it. We encourage our members to look at the pros and cons equally of anything that they are considering in property investment. People talk to me and say, Michael, I don't like apartments. I don't wish to buy an apartment. And I say, that's entirely up to you. Here are the pros and the cons of an apartment. Oh, I didn't realise they had those pros. That's okay. You might prefer a house. Did you know that houses have pros and cons? Here are the cons of a house. Oh, I didn't realise that. So these are the things that we do when we work with Property Club members. Your questions get answered, and they are a priority for your property mentor. Support, support, support. And this service comes at absolutely no cost to you. So we have property researchers that exist in major markets around the country who are looking for the opportunities in the marketplace that are suitable for Property Club members. As you can see, they select areas based on a range of things: population, infrastructure, employment, healthcare, transport. In fact, there's 13 factors that we use, and they're called the 13 critical factors. Ask your property mentor when they make contact with you to explain what those 13 factors are. They've been the backbone of Property Club for 26 years, and they will continue to be, because they're really important. These are factors that distinguish us from our competition, because we stand behind these factors and we only research properties that align with them. To find properties that match these criteria comes at no charge to you. We will help you find a tenant quickly for your property. When I talk to potential property investors and current investors, the biggest fear they have is not having a tenant, and that's fair enough. So we do a process called multi-listing. So what we're trying to do with our clients is we're trying to minimise the vacancy of their rental property. I've yet to meet a property investor who has had no vacancy in their property. So looking to minimise it is more important. So what we can do is we work with local letting agents, and we actually ask them to compete with each other to find a tenant for your property as quickly as they possibly can. That doesn't mean they take shortcuts. We make sure that all the potential tenants that are shown through the property have done the appropriate background checks. But this has proven time and time again to reduce vacancy periods for Property Club members. This service comes at no cost to you. A really critical thing when people are investing in property, and I've seen it a number of times where people who have purchased properties before they join the Property Club, they can't articulate if the property is making them money or costing them money. So we use a chart. Now, you've got two different methods that we use to look at the cash flow of a property for a client. This is a more simplified version. It's also probably the most popular version that we use because it is so straightforward. There's an example down the bottom of a property for $450,000 and a rent for $20 a week. You can see the other assumptions just next to that on the right-hand side. So we apply those figures in our calculator, our cash flow projection tool, and it comes up with a graph like this, which is the weekly cost to hold the property. Column 1 in red is the out-of-pocket expenses for that property in that week. Column 2 in green is the rental income that property generates per week, and that has been reduced already to allow for property management fees. Column 3 is the tax savings that would be generated by owning that property. And column 4 in yellow, the 52 here, is an example of where this property generates $52 worth of income, that's not loss, into the hands of the investor per week. Column 5, the black column, is an explanation of if the property was doubling in 12 years, because that's an assumption we put in down the bottom. If it was going to double in value in 12 years, then each week the property is growing by $519 in value. Now, what we know is that that's not always right, and that's an average measure, but it gives some sense of what is happening on a week-to-week basis. And after this, I'm going to ask Roger more details about this property because I like the idea of a property that puts $50 a week into my pocket and is growing at $500 a week. We do these assessments as a property mentor. We do these assessments for our members and our clients regularly. Sorry, I should have said here, this service is at no cost to you. And why is all this at no cost to you? Because we charge referral fees to the person who's selling a property. So we then take that fee and apply it to the services in our club that are there to support you. So it becomes a circle, and the money ensures that you get ongoing service and assistance. And what it also does is make sure that that money doesn't end up in the back pocket of a real estate agent funding his late model Mercedes or BMW and the shiny suit. We're real people in the property club, and we fund our services through the income that we receive from a vendor who sells a property through us. Now I'm going to pause and hand over to Joe, and Joe's going to talk to us a bit more about finance.
Thank you, Michael. If we can move to the first slide, please, that'd be great. So when we're talking about finance, in the finance market, as we know, is changing quite a bit. And just as a property mentors and your researchers in the property club, they find a particular property for you that's designed for you and your portfolio, finance is no different. So our job when you come to us is to have a look at different lenders, and we're out there working hard for you to find the best lender that's going to suit your needs at your particular time. In the current environment, a lot of people are asking us, that their current lenders won't renew their interest-only loans. So as property investors, we want to, if we can, pay interest only because that helps with our cash flow and it helps us to hold our portfolio. So that's part of our job. We've got 45 different banks out there that we can have a look at, and we can see which lender is going to suit you best and which lender we can potentially put you to so that we can reset your loans back to interest only. We'll find the best loan products for you also. So when we're talking about loan products, we might be looking at your interest rates for you. In the current market, there's some great interest rates out there. After this, I would encourage you to all have a look at your home loan. See if your interest rate is above 3%. If your home loan rate is 3% or more, then you're paying too much. Okay, so that means you're throwing money down the drain. So very, very important to check your home loan interest rate and even your investment rates too. Okay, because investment rates these days, you can get variable rates, down to about 3.3 and a bit lower, and fixed rates, you can get them as low as 2.59. So it's about looking at the different lenders for us. We've got 45, so different lenders that we can work with, and we'll find one that's going to suit you the best. Now, a lot of people say, Joe, well, I've got my bank manager, he's great, and I'm sure he probably is great, but the banks can only offer you their loans, they can only offer you their products, they can only offer you their interest rates too. And if you're looking at buying a property and you go to your current lender and they say, well, sorry, you don't have any borrowing capacity with us, does that mean that's the end of the road for you? Well, no, it doesn't, because we as brokers, as I've said before, have access to multiple lenders that have got multiple lending criterias, multiple rates, multiple products. And quite often we do find that we are able to refinance people, save the money. This year, last year, we've saved people tens of thousands of dollars per year by just having a look at the interest rates. So if you haven't done that recently, please have a look at doing that. Thank you, Michael. So when we design the finance for you and you're looking at buying a property, some of the things that we'll ever talk to you about is, okay, well, if you're going to buy a property, we all know that you've got to come up with your deposit, your stamp duty, and your legal fees. So where do you get that money from? Well, there's 3 different ways that you can do it, and we can go into more detail with you, when we have a chat to you. But if you've got existing property that's grown in value, you can potentially take the equity from there. you might have saved up enough money to buy another property, or you might be lucky and you might have the bank of mum and dad that can assist you, or it might be a combination of all three. So they're things that we can discuss with you when you are looking at buying a property. So how much do I need? Well, this one here is really, really important, because one of the things that we do from a finance point of view, before you even pick a property, is that number one, we need to know that you've got enough to cover the purchase. But there's another important part that we also try and make sure that you've got, and that is a buffer. Okay, so buying a property is great, but let's make sure you've got extra piggy bank there in case something happens and you need that money to fall back onto. Lender's mortgage insurance, it's another very, very important topic that we go into quite a bit of detail with. So if you don't have enough money to go for an 80% lend, so which means 20% deposit, stamp duty and legal fees, if you don't have that, well then you can actually use lender's mortgage insurance. And I think it was Michael that was talking about using other people's money. Well, this is what he was talking about, because lender's mortgage insurance allows you to borrow more from the bank, and it allows you to use the least amount of your own funds. So yes, mortgage insurance is a cost. However, mortgage insurance can also be a property investor's best friend, and we can discuss that with you at a later time also. So finally, we can show you how much you can borrow. And as I said before, if you go to your bank, your bank's got their own lending criteria, and that lending criteria may be a lot stricter than some of the other banks. And you'll find that borrowing capacities between the banks can differ by quite a bit. So if your current bank has said to you, you can only borrow 300, well, there may be a good chance that another lender, maybe a second tier lender out there, can allow you to borrow more money so that you can get into your next property. Thank you, Michael. So when you're looking at borrowing for a property, or if you're thinking of looking at doing a financial health check, this is a really, really important form. And for those of you that have been with the property club, you would know what this form is, okay? It's a financial wealth check form. And this form is used for a couple of different purposes. Number one, if you're looking at buying a property, this is the form that you would fill out. If you think it's a little bit too complicated, you can fill out as much as you can, and your property mentor or your broker can give you a call back, and they can fill in the missing details for you, so that we can come back to you and say, okay, based on the information that you provided, you can borrow X amount. But you may not be looking at buying another property. So is this form still useful? Well, yes, it is. I was talking about doing a financial health check. So you can fill in this form here also. You can put down your incomes, you can put down your property values, and they don't necessarily need to be 100% accurate, the actual values, but you can put down how much you owe on those properties, which bank you're with, what your interest rate is. And this will give us as the brokers the opportunity to give you a call personally and say, okay, this is what we can do, and this is how much money we can save you, okay? Because don't forget that property investment, it is a long-term strategy. It's not a short-term strategy, so you do need to be able to hold the property for the long term. And as we've all heard before, cash flow is king. If we can save your money and you're going to increase your cash flow, it means that it's going to help you to hold your property portfolio for a longer period of time. So that's the end of our presentation tonight. So I just want to thank everybody for coming on tonight. If you've got any questions, remember, as Michael said at the start, please type them into the chat box, and we'll give you a call personally to have a chat to you. If you don't know who your property mentor is and you're new to the club, don't worry about that. A property mentor will be allocated to you. It'll be somebody in your own state, and they'll give you a call and they'll have a chat to you also. So thank you very much for joining us tonight, and we look forward to seeing you at our next webinar. Thank you.